welcome everybody to this version or series of our deep dive webinar. As an introduction, my name is Tyler Oliverson. I am one of the tax professionals here at Mazuma. And I've been in the public accounting world for about 20 years, working with individuals and small businesses. So welcome. Glad you're here today. Hopefully your Monday and beginning of the week has been a good one, and it continues throughout the week for you there. We will have a little bit of a presentation, just going through some slides, and we will have a question and answer session afterwards. So if you've got questions as we're going through, we can't answer raised hands, but you can go ahead and chat in your questions. Go ahead and put those in. We'll get to them at the end, and we'll just answer those, as many as there are, and in the order that they come in, okay? So let's go ahead and get started. Today's subject is getting the most out of your taxes and accountant. What we're going to do is a little bit of a flyby on this one. We're not going to get into too many specifics other than a couple of little things. What we want to do is give you an idea of what you should be expecting from an accountant when you're running a small business. I have to scroll the other way. I was scrolling down. I gotta, let's see here. There we go. Sorry about that. It's probably an Apple product instead of a Microsoft product there. We're scrolling the wrong way. I'm an accountant, okay? I'm not technologically savvy. I'm having a hard time with this thing they call a mouse today, it seems like. Just kidding. All right, here's what we want to do. One of the most important things in accounting is getting organized. You need to be organized. And when I first meet with a client, I like to tell clients that accounting is more like putting a puzzle together than it is doing math. People find out I'm an accountant, and they go, man, you must be really good at math. And I go, well, I can add and subtract pretty good. That's about it. Sometimes divide, but I need a calculator, right? When I look at accounting, I look at it more putting a puzzle together. If I have all the pieces, but I don't put them in the right places, I never know what the puzzle looks like, or at least it looks funny, right? If you were a little kid, when I was a little kid and I tried to force those puzzle pieces together, it never looked right. So one, we want to get organized, and I really do. I think of accounting more as a puzzle or as a problem to solve. Now, if we as accountants have all the transactional detail, right, that's everything that's happened in the business financially. But I don't organize it correctly, it's not going to give me a full picture of the business. I don't really know what's going on. So getting organized, number one, is the most important thing that you need to do, and get your accountant to help you do that. And that, honestly, it takes a lot of communication. You and your accountant should work together to maintain up-to-date and accurate financial statements. In this, one of the most important things you can do is ask questions of your accountant. And ask them early on in your relationship. Ask before you do something that you're uncertain how it's going to look or affect your taxes or your accounting. Don't do it and then sit down with your accountant 3 months into the next year and say, hey, I did this. And the accountant goes, I wish you would have talked to me before. We could have structured this a little bit differently, right? So communicate, so that we can keep up-to-date and accurate financial statements. We want to make sure everything is accounted for and accounted for correctly. Now, this next bullet point, I put maintain separate accounts. Maintain separate bank accounts is what I should have in here. Maintain separate bank accounts for personal transactions and business transactions. It's vital for a business owner to keep their personal finances separate from their business finances. A business owner should not pay for personal expenses out of a business account, nor should they pay for business expenses out of a personal account. We actually call this commingling. It's more of a legal term, but it has some consequences on the accounting side. When a business owner pays for business expenses out of their personal account, oftentimes some expenses get missed and not accounted for. This can result in higher taxable income. And guess what? Higher taxable income results in paying more taxes than is necessary. So we want to avoid this. It can get messy. Don't commingle. There's some legal reasons for not doing it. I would suggest you talk to a lawyer. I'm not a lawyer, but there are some legal reasons for not commingling as well. But even on just the accounting side and the tax side, there's good reasons for not doing it. It's messy, you miss things, and you may end up paying a little bit more tax or a lot more tax than you need to. So we want to avoid that. It's always advisable to pay expenditures that are 100% business out of the business account. I know that sounded redundant. It was, and it was for a reason. Pay for business out of the business account. If you need more money in your business account, transfer it in from your personal account and then pay for it out of the business account. Okay. Now, not all business expenses are 100% business. Some are actually, there's a mixed use. There's a mix of use between business and personal. Now, when this happens, we recommend tracking these expenditures outside of the business and then making adjustments to the accounting records or having the business reimburse the owner for the expenses. This does require a little bit additional bookkeeping or record keeping, but that's okay. We want to keep these separate and we want to take the deductions. What I'm going to do is I'm going to talk about a couple of those here in a minute. We're going to start it in this way. Many small businesses are based out of their homes. Okay, when I was a sole proprietor, tax preparer, and accountant, I worked out of my home, had my office downstairs in a bedroom. My kids would come in and they would play with my 10 key, right? It was an old one that had the tape. It was great, loved it. They wanted to sit on my lap and type. It was a lot of fun. But a lot of businesses, they have their office in their home. Well, that's not 100% business use. Your home isn't anyway. And so there are some expenses that are both business and personal use. In the case of personal residences and your vehicles, right? Your vehicles are another one where you only have one vehicle maybe, and you drive it personally, drop the kids off at school, you go grocery shopping, whatever it might be, date night, okay? And then you drive to your clients' locations of business, right? So these have both your homes oftentimes and your vehicles oftentimes have a personal component and a business component. And this is where this additional record keeping comes into play. You want to be able to track the full amounts of these expenses and take a portion of those expenses when it comes to the business. So let's talk about these two and what is required to track both the home office deduction expenses and the auto expenses. First, let's take a look at the home office. This is not me. He's a lot better looking than I am. He doesn't have any gray hair yet. But here I am, here you are, you're working out of your home and you want to be able to take some of the home expenses as business expenses, which you can do. It's allowed by law. So what we do is we have to keep track of some of these housing expenses. First, we start with square footage. You measure the square footage of the area or areas used exclusively for business. Now, this is important. Exclusively for business is important. It can't be a shared space when it comes to a home office deduction. It has to be exclusive to the business. So generally, we would use a separate bedroom or we would cordon off. Somehow we would make an area distinguishable from our other living area. So first, we take the square footage of the area used exclusively for business. Then we take the square footage of the entire residence. We divide the square footage of the area used exclusively for business by the total square footage of the home, that gives us a percentage of business use. Whether that's 5, 7, 10% more, it could be. It's whatever it actually is. There's really not any limits to this. And then what we can do is we can take that percentage of some of our housing costs. So if you rent, you can take that percentage of your rent as a business deduction. If you own your home, you get to take that percentage of your mortgage interest and property taxes. Okay, not the mortgage payment, the mortgage interest and property taxes as a deduction. Now, if you own, you do get to take the cost of your home, what you paid for it, no matter how long it's been since you paid for it, it's what you paid for it. You get to take that percentage of the cost and you get to depreciate it over time to get a little bit of a business deduction there. You get that percentage of utilities and you get that percentage of like large general repairs to the home. For example, a new roof, or you put in a new AC unit or a new furnace, things that are general to the entire home. You would actually be able to take that percentage of those repairs as a business deduction as well. Now, I didn't put this in here, but there is a simplified method to this. And that is that you can take the square footage of the area being used exclusively for business and just simply multiply it by $5. Now that's for the total year. There is a maximum to this one, and that's a $1,500 total deduction. Oftentimes we find this other way to be a larger deduction. So we do want to keep track of the square footage and all of these other things, utilities and rent. We usually get a mortgage statement or an interest statement at the end of the year that has a mortgage interest and property taxes on it. So that's some additional record keeping that you'd have to do. And you can elicit the help of your accountant in knowing what to track and how to do that. So that's the home office deduction. If you've got additional questions on that, go ahead and throw them in the chat. We'll get to them when we finish up the PowerPoint portion of our presentation. But let's talk about the auto deduction for a second. There's actually two methods for doing the automobile deduction here as well. And this would be using your personal vehicle for business purposes. Now, if you've got a vehicle that is 100% business, it's a little bit different than this. I'm going to be talking about simply, this is your personal vehicle and you use it for business as well. There's two methods. One's the standard mileage deduction, and the other is the actual cost method. Now, both of these methods require a mileage log. You can't just guess. I think it was 28,000 miles. Nice big round number, a whole bunch of them for the year. Maybe it was more, maybe it was less. You actually need to keep a mileage log. And this log establishes your business use of the vehicle. It also, it's the documentation that proves that you use your vehicle for business use. So here's some things that need to be on your mileage log. You need to have dates. So what I used to do is I'm old enough back in the day before applications on a phone, I used to have a little notebook. And every day I drove somewhere, I would put in there the date, where I went, the beginning, ending odometer, the total miles for the day or for that trip. So you need dates, destinations, miles for each business trip, and you also need the total miles for the year. So in my little book, I'd put the beginning and ending odometer for the year. So that is very similar to the home office deduction. It sounds like it, right? Take the whole entire year's mileage, divide that into the business mileage based on my log, and I get a percentage use of my vehicle for that year. Now, there are apps. You don't need a notebook. I still probably would use one. There are apps out there that you can get that will, but based on GPS, they will track every time you drive around in your vehicle, and it'll ask you, hey, was this personal or business? You swipe whichever one it is, and they will give you a log of all your trips. And that can be sufficient. I like that you have maybe the destinations on those as well. And if you wanted, you could put a business purpose in there. The more, the better in this type of a situation. But you want to substantiate your actual business use. Now, I want to tie the home office deduction, and I don't have a slide for this, but I want to tie the home office deduction and the auto deduction together. And here's why. When it comes to auto deduction, the only mileage that is deductible is from a business location to another business location. Commuting is not a business deduction. So if you had an office downtown and not one in your home, and you drove from home to your business office, That's a commute. It's not deductible. Well, what if your office is in your home, right? You have a home office. Well, anytime you leave your home for a business purpose, whether it's the office, store, to see a client, to the mail's box or whatever it might be, now you're going from a business location to your office, to another business location and back. All of that now becomes deductible mileage for auto expenses. And so that's those two, the home office and the auto deduction, actually work together very well. So you've kept this mileage log. Now let's look at the two different ways of taking mileage or vehicle deductions. One's just the simple standard mileage deduction. It's also called the simplified method. You use your mileage log and you multiply the miles times the standard rate for the year. This year it's 56 cents per mile. Last year it's 57.5 cents per mile. Changes every year. Occasionally changes in the middle of the year. Next year we'll have a new standard mileage rate. A lot of it fluctuates based on price of gas and some other things. But you just simply take the miles, the business miles based on your log, multiplied by the standard rate, you get to take it as a deduction. Now there's an actual cost method. This requires a little bit more record keeping. On this one, you do the same thing. You take the business mileage based on your log, divide it by the total miles for the year, gives you a percentage of use, and you can take the cost of the vehicle, that percentage of the cost of the vehicle, and depreciate it. You could take that percentage of fuel as a business deduction, that percentage of repairs and maintenance as a business deduction. The same thing as insurance, that percentage as a business deduction. Now, one thing that's important to note when it comes to the auto deduction is you have to maintain consistency from year to year with a given vehicle. So if in the first year you decide you want to do the actual costs with your vehicle, you have to maintain the same method with that vehicle until you no longer use it in the business. Now, when you get a different vehicle or start maybe using a second vehicle, you can switch for that vehicle over to the standard mileage or vice versa, but you have to remain consistent. You can't do the actual cost one year and then switch to the mileage cost or mileage deduction the next year. It has to be consistent. Now, those are two pretty common deductions that we talk about a lot for small businesses. Now, here's something else you really want to do with your accountant. Is you want to do a tax projection. I don't know how many times I've had a new client come in who started a business. They'd never used an accountant before because they just always did their own tax return. All they had was a W-2. Now they started a business and they ran the business for 8, 9, 10 months of the year. They were like, wow, I think I need an accountant. So they come in and they see me after the year is over. And they say, hey, we did awesome this year. We made $50,000 in this brand new business. We put all the accounting together. Lo and behold, yes, they did. And they're just super excited until I tell them, that's great, but now you owe $14,000 in taxes. And I've seen tears, a lot of colorful metaphors, right? Those four-letter words we hear oftentimes make your ears burn a little bit. Sometimes it's heartbreaking. So what you want to do is you want to do a tax projection if you can. If you've got a relationship with an accountant, do a tax projection. We do these here at Mazuma for our Plus clients. It's very, very useful. What we do is we run a projection based on some estimates, right? We're not at the end of the year yet, but we run a projection. We figure out what we think your total income is going to be, what withholdings you may have already had or tax payments you've already made. And we basically prepare a tax return. And at a minimum, what this does is it gives you an idea as to what you're going to owe, or if you need to be making payments. And it just gives you a peace of mind. Okay, I'm really doing well in business, but gosh darn it, I'm going to owe $15,000. Well, now I can start planning for that. Or I could start making some payments so that it all doesn't hit me at one time. At a minimum, that's what it does. But what it really does for us is, one, it puts us in contact, we're communicating, we're building a relationship, and it gives me some planning opportunities. I've listed 3 things here that we oftentimes discuss with clients, especially new clients. One is the entity type that you're using for your business. Is it the best thing for you? Maybe it is. The entity you've already set up. Maybe you're an LLC, and you know what? Right now, you should be an LLC, and you should be an LLC taxed as a sole proprietor. But maybe we should move you to an S corporation or a taxed as one. So this is what we can figure out when we do a projection. Also, we can do things like, is it good for you to buy some equipment? We don't spend money just to have a tax deduction, but oftentimes if we've got some unequal income from one year to the next, it's nice to either pull in equipment purchases into the current year and take a full depreciation, or if we can, maybe it would be better to wait and do an equipment purchase next year if I can live without the equipment. So that can help. Another thing that we can look at when we sit down and do a projection are retirement plans. I'm not a financial planner, but I'm going to sit down with my clients and I'm going to say, hey, look, you're starting to do really well in the business. We've moved your entity type maybe to one that is a little bit better tax advantaged for you. We're doing some equipment purchases as need be. Some of you are in the service industry and are not going to have those, but we'll look at them. What's next? Oh, you know what? I've got a client that maybe they're making enough money that they would like to start funding a retirement plan. Well, in a small business, in many cases, funding your retirement plan is a deduction to the business. It's a way to avoid taxes. So there's some things that we can do in a projection that is really, really nice. And these are really nice to have, especially if your business is changing. If it's pretty static and it's almost the same year to year to year, which some businesses are, you don't need a lot of planning maybe because not a lot is changing. But when your business is dynamic, it's brand new, it's starting to grow, or maybe it's going to have a dip for a little bit, but then it's going to come back. Well, let's do some planning around that. And projections are really, really essential in that planning process, okay?